Hey everyone, welcome back to the channel. If you're new here, hit subscribe and tap like so you don't miss any of my deep dives into stocks that make big moves. Today, we're taking a closer look at Opendoor Technologies, ticker OPEN. This is one of those companies that keeps attracting attention from investors because of its bold approach to real estate and the dramatic swings in its share price. Whether you're watching this the week it comes out or months later, the key points about what Opendoor does, the catalysts behind its recent surge, and the risks to watch remain the same. Opendoor is a tech-driven real estate company. The idea is to make it easy for homeowners to sell their homes quickly online, bypassing much of the friction of traditional real estate. They buy homes, do some repairs, and resell them. It's a business model that works when real estate markets are favorable, interest rates are reasonable, and demand for housing is strong. But when things are weak, it can be very hard because you carry inventory, repair costs, borrowing costs, and all the associated risk. People often forget how capital-intensive this model is and how sensitive it is to macro conditions. That's why the story of Opendoor has been one of extreme highs and lows. Open has had a wild ride. Shares were trading low earlier this year below $1 at some points. Then, momentum started to build. People began buying in because of talk of leadership change, social media buzz, short interest, and hopes that the company could turn things around. Recently, it all escalated. The company appointed Kaz Nejatian, formerly COO at Shopify, as its new CEO. Meanwhile, the co-founders Keith Rabois and Eric Wu returned to the board of directors. Rabois is now chairman. That combination of new leadership, founder return, and retail investor enthusiasm ignited a huge price jump. Also very important, there was fresh capital injected. Khosla Ventures and Eric Wu both committed about $40 million in equity investment under securities purchase agreements. That gives the company some breathing room for operations, for investing in technology, maybe for cash costs and keeping the business alive during this turnaround. The share price reaction has been dramatic. On the biggest day, Open stock jumped about 69% in a single day. Retail investors have played a major role. Social media sentiment has been strong, and there's been a narrative around founder mode. People believing that bringing back the founders means a renewed vision, more discipline, and maybe more risk-taking for growth. There's also been a feeling that with new leadership, Opendoor might finally find a path to profitability, or at least a clearer long-term plan. There is upside potential here if things go well. The leadership change could bring in better execution, clearer strategy, perhaps cost control, or better product offering. The fresh capital helps them avoid immediate cash stress. And strong retail sentiment can sometimes drive stocks much further than fundamentals in the short term. Also, if the housing market stabilizes or improves, Opendoor could benefit because much of its costs are related to holding homes and flipping them, so better interest rates or more demand would help. AI and tech-oriented leadership gives people hope that there's a modernization plan, maybe improvements in pricing, algorithms, or how they source and sell homes faster. If you think about it, Opendoor started as a disruptive idea, applying technology to a very old-school industry. With the right leadership and enough cash runway, that original vision could still be realized. But there are big, serious risks. The financials are rough. The company has not been profitable. Losses are expected to be large in 2025. Revenues have dropped significantly from their peaks a few years ago. There's burn and inventory risk. When you own homes, you bear cost of maintenance, repair, financing, insurance, and all that. If homes sit unsold, that hurts. Guidance is weak. Some analysts expect revenue drops in upcoming quarters. Projections are mixed. If revenues decline and they can't rein in costs, the losses could increase. Also, margins might be squeezed. Housing market conditions, interest rates, lending rates, and macro conditions matter a lot. If rates are high, financing is expensive and home purchases might slow. That's outside company control to some degree. Valuation is bizarre. Because the stock has risen so much, many analysts say the upside from here depends heavily on sentiment, whether short interest stays high, whether retail continues to ride the wave. Some price targets are very low, suggesting that people see downside risk as very substantial. There's risk of a correction. If the narrative fails, say leadership change doesn't bring results or operational issues emerge, this could fall quickly. Volatility is extreme. With high short interest and with a large retail investor base, the stock can swing wildly. Some days, big gains. Other days, big drops. If you get in, you need to accept that you might see big downside volatility. Also, there's risk of regulatory or market backlash if people think it's just hype. Another risk that isn't always mentioned is execution complexity. Scaling a business like this requires tight operational discipline, accurate pricing models, reliable contractors for repairs, and access to cheap capital. One misstep can eat up margins fast. What should you watch for in the coming weeks and months to see if Open is going to deliver or disappoint? Progress reports from the new CEO. What is the strategy? Are there specific cost cuts? Are there operational improvements, better tech, better home sourcing and selling? Cash flow and cash burn. How much money they have, how long it lasts, how they manage debt and inventory costs. Upcoming earnings guidance. What estimates they give for revenue, operating margin, and losses. If guidance is much worse than people expect, the stock could fall. Housing market external data. Interest rates, home price trends, buyer demand. If these conditions worsen, they can seriously affect Opendoor, market sentiment, and short interest. If short sellers are forced to cover, there could be upward volatility or a sharp fall if shorts start piling in again. Operational metrics. Percentage of homes sold, days in inventory, resale margins, repair costs. Those numbers are crucial to understanding whether the model is actually improving. And perhaps most important of all, transparency from management. Will they clearly communicate their plan, show milestones, and build credibility with investors? Or will they go silent and leave a vacuum filled by speculation? My view is that Open is a story that looks very speculative, but with a certain charm if you're tolerant of risk. I wouldn't use it as a big core holding without strong proof of execution. If you're more aggressive, it might be worth a small position to capture the rally, but be prepared for possible sharp corrections and always have an exit plan. If you're more conservative, it might be better to watch from the sidelines until you see actual improvement in the business metrics. Remember, headlines and leadership changes can move a stock. But sustainable performance comes from execution, profitability, and cash flow. Wrapping up, Opendoor has captured attention for good reasons. New leadership, founders back, fresh capital, and a massive rally. But the hard part is ahead, turning that enthusiasm into real results. This is a company with a bold idea and a lot to prove. If it succeeds, it could reshape how homes are bought and sold at scale. If it fails, it will be another cautionary tale of a disruptive concept that couldn't overcome market cycles. Either way, it's a fascinating story to watch. Thanks for spending this time with me. If you liked this breakdown, hit like, subscribe, and drop in the comments what you think. Is Open in founder mode really, or is it another hype story? I'd love to hear your thoughts, and I read them all. Stay curious, stay informed, and see you in the next one. And just before we end, one last important note. I'm not a financial advisor, and nothing you've heard in this video is a recommendation to buy or sell any security. It's purely for informational and educational purposes, so you can do your own research and make your own decisions.